Hi everyone, this is Craig for the Options Linebacker Top 10 Market Lessons for 2009. This is a short video showing all the things that I think have changed in the marketplace or that we might need to be aware of going forward to be able to successfully trade with an edge. Starting off with Lesson 10, it is now a 24-hour global market. What does that mean? The global financial world used to revolve around the New York Stock Exchange, but these days what we're seeing is just about every morning we're seeing a big overnight gap either up or down because the market tends to follow the sun depending on what Asia or Europe is doing. So learn about futures, learn about currency pairs so you can come prepared to trade the market that morning and factor in any overnight gaps that have occurred. Number 9, what goes down must come up. A year ago when I did these lessons, I said, you know what, it's a bear market. Well, what goes down must come up. The 2007 to 2009 bear and the 2008 crash were so far the second worst move in our history. Think about this though. Take a super ball up to the top of a skyscraper and drop it. How far would it bounce when it finally came back up again? Almost all the way. And that's what we've seen since March of 2009. So right now the real fun begins because the market has normalized itself again. And lesson number 8, technical chart patterns are not what they used to be. Things have changed here. What's happened is that institutions and the investing public have now become a little bit more sophisticated. If you told somebody what a Head and Shoulders was 5 years ago, nobody would have known what you're talking about, but now a lot of people do. So when something has become obvious to everyone, usually the opposite will happen. So going forward, be very skeptical of any obvious patterns that you're seeing, especially ones that are featured in the mainstream media. So that fits in with contrarian market theory. Our next lesson, number 7, is declining volume into a rally is no longer a valid leading indicator. Now this is one that we looked at in 2008. Here's a couple of good examples, the one in the springtime rally and then into late summer. Both of those rallies, if you look, happened on declining volume, and that was a good leading indicator to show that both of those rallies were probably going to fail. But as we go forward into 2009, the rally, especially the one that we've had since July, has been on lighter and lighter volume, and nothing has happened. It just keeps on chugging higher. Now, I believe there's several concrete reasons for this lighter volume, but it doesn't necessarily mean that the market's going to roll over tomorrow, which a lot of bears have lost their hides on so far. And that leads us to our next one, lesson number 6. The VIX is no longer a very good leading indicator. It used to be a terrific one. Once you get up to a value of about 30 VIX in this area, this was a great area to be able to sell against, and this happened for several years in a row. Every time we'd spike out at about a 30 VIX, that was a great time to sell, and it would show that the decline was most likely over at that point. But now in what I'll call the post-crash VIX, after the crash itself created this VIX spike up here, really it's just been bleeding south since that point. The only leading signals that we've gotten have been anything outside the Bollinger Bands are a likely buy signal so far. So we'll watch for that, but apart from that, so far the VIX right now is just not a very good leading indicator anymore. So of course that begs the question, well, what is working? And that's trading simple price action on charts is still working very, very nicely. What do I mean by price action? Well, let's look at the chart here and we can see that just simple things like trendline breaks to the upside are a good buy signal. And if we look at this, we have a series of higher highs, higher lows. This is standard Dow theory, price action. This is old school stuff and it still works as long as we're not penetrating any trend lines to the upside, as long as we're making higher highs, higher lows. You could still buy the dip during this whole period. So there's nothing fancy here. There's no special indicators that are working or not working or showing leading signals or not. It's just straight old price action is still not going to lead you astray. Now, lesson number 4, I included this on last year's top 10 list, and I'm including it again this year because I think it's such an important lesson that there is no holy grail when it comes to either its indicators or whether it's strategies. So many traders are just forever in this downward spiral of chasing this holy grail of trading. What happens is that they'll run something until they take their first loss, and then as soon as they do, they're off chasing the Holy Grail, trying to find some other strategy that's going to prevent loss. And usually they're late to the party by the time that they actually jump on that new strategy. So they get faded, and then they start the cycle all over again. Get good at one thing as your base level strategy. Build on top of that. Kind of the same thing as in golf, learn how to hit a 7-iron and you can hit just about anything after that, but learn that one club first and get really, really good at it. Now, lesson number 3, this is kind of unusual for me because usually I just try to stick to the charts and don't, fall into politics or anything like that. But lesson number 3 is do not assume that Congress has your best interests at heart. Right now, there's a current bill going through the House, Let Wall Street Pay for the Restoration of Main Street. It's intended to punish Wall Street for the 2008 crash and the bailout, and then kind of how they rubbed everybody's face with the 2009 bonuses they've already paid out. But what this is going to do is it's going to impact the small guys like you and me. So make sure that your rep and your senators know your stance. Help educate them. They might not understand how much this is going to hurt the little guy. Now, lesson number 2, contraction leads to expansion and vice versa. What do I mean by this? Again, this is kind of an old school charting thing that when we look at this chart, what I've done is I've placed the Bollinger Bands on here to kind of show the volatility and how that's changing. But when you do have a market that is kind of coiling sideways here, or contracting in its range, what it's getting ready to do is expand, and this is what's happening here. So it's going between a cycle of contraction and expansion. So here we have some more contraction before we have another cycle of expansion, and here we have another cycle of contraction in here before we have another level of expansion to a next level, and then we've repeated the same cycle again and again and again. And this is how markets work. If you're seeing a market contract in volatility, it's getting ready to, more than likely, expand in volatility again, or expand in range. And that leads me to lesson number 1. Every trading strategy needs to adapt to the current state of the market. What do I mean by that? The market states. There's 4 different types. There's stable and quiet, stable and volatile, trending and quiet, trending and volatile. I'll show you what these look like in a second here. We've seen all 4 types of these market states in the past 4 years. Early 2006, this was actually very stable and quiet as we went through the first half of the year with very low volatility, a little bit of expansion and contraction, but occurring on a very small basis. So from there, late 2006 was trending and quiet. Very, very low volatility. We got to a single digit on the VIX before this trend was over. 2007 and actually into early 2008 was stable and volatile. Stable because it didn't go anywhere. Look at this. Where the prices end up was about when they started, but very, very volatile. And of course, as we got into 2008, we had trending and volatile, and 2009 has also been trending and volatile. The point here is that each of these market states requires a different approach to the market, whether or not you're doing income strategies via option selling or if you're just buying and selling stock, things like that. So after 3 straight years of volatile markets, the past month of sideways price action might be showing us that an exhausted market might be ready for quieter volatility again. We will see. So with that, thank you very much for watching. I think 2010 will be an excellent year for us. Have a safe and successful new year, and good luck in trading, folks.
You've been